Hello, and welcome to Finance Decoded. Once upon a time, cash was king. It bought empires, funded wars, and filled pockets across centuries. But the king is losing power, quietly, globally, and maybe forever. From Beijing to Stockholm, from Lagos to New Delhi, the world is rapidly moving toward digital money. Governments call it innovation. Economists call it efficiency. Critics call it control. Welcome to the age of central bank digital currencies, the new frontier where technology, finance, and power collide. In this video, we'll decode why cash is disappearing, what's replacing it, and how the shift could redefine freedom itself. Let's start with the numbers, because they tell a powerful story. In Sweden, less than 8% of all transactions are made with cash. In China, over 90% of urban payments happen through mobile apps like WeChat Pay and Alipay. Even in traditionally cash-heavy economies like India, digital payments through the UPI system crossed 10 billion transactions per month in 2024. Globally, cash use has fallen by more than 50% in the past decade. And in some places, stores simply refuse physical money, not out of arrogance, but because they literally don't have change. The shift began with convenience. Tap, scan, done. But what started as a consumer trend is now a systemic revolution. For a long time, governments didn't care much about digital payments. The private sector, fintechs, tech giants, and startups led the way. Then came cryptocurrency. Bitcoin showed that money could exist without a state. That terrified central banks. Suddenly they realized, if they don't innovate, they'll lose control over money itself. So, they began developing their own versions of digital cash, Central Bank Digital Currencies, or CBDCs. Over 130 countries, representing 98% of global GDP, are exploring or testing CBDCs. China's digital yuan leads the race. India's digital rupee pilot is expanding. The European Central Bank has moved into the testing phase of the digital euro. Even the US Federal Reserve is researching a digital dollar, though cautiously, given political resistance. In short, every major central bank is preparing for a future where money doesn't exist as paper, but as programmable code. Why governments love digital money? Governments have strong incentives to go digital. First, transparency. Digital payments reduce corruption and tax evasion. Second, speed. CBDCs could deliver stimulus payments or welfare benefits instantly. Third, monetary control. Imagine being able to issue money directly to citizens without commercial banks as intermediaries. And yes, there's a fourth reason: data. Every transaction becomes a data point. For central banks, that's economic intelligence. For citizens, it's surveillance risk. It's a double-edged sword. Efficiency meets oversight. So, how do CBDCs actually work? Think of them as digital cash, but centralized. Unlike Bitcoin, which runs on a public blockchain, CBDCs often use permissioned ledgers, systems controlled by the central bank. Transactions are verified instantly. No mining, no speculation, no wild volatility. Some CBDCs are account-based, like having an account directly with the central bank. Others are token-based, more like holding digital cash in a wallet app. The Bahamas' Sand Dollar uses mobile wallets connected to phone numbers. China's e-CNY can even be used offline, with NFC chips that transfer value without the internet. This isn't just fintech, it's financial infrastructure 2.0. CBDCs aren't just about payments, they're about policy power. With programmable money, a central bank could issue funds that expire after 6 months, pushing people to spend faster during a recession. It could target stimulus to specific regions or industries with precision, or impose negative interest rates directly on digital wallets to encourage economic activity. These are revolutionary tools, but they come with moral and political dilemmas. When money becomes code, someone must write the rules, and those rules decide how people live, save, and trade. That's why even some economists warn, a CBDC isn't just digital cash, it's cash with conditions. However, some people are, against a cashless world critics, warn that a fully cashless society could create a new form of digital dependency. In 2023, when Nigeria introduced the naira, citizens resisted. Cash shortages sparked protests. Many feared the government was pushing digital payments too aggressively. Without proper infrastructure, in countries like Sweden, older citizens worry about exclusion. Not everyone owns a smartphone or trusts online banking. Privacy advocates fear a dystopian scenario where every purchase is recorded, analyzed, and possibly censored. Think of it. If your digital money can be tracked, it can also be blocked. In China, some see the e-CNY as a potential tool for state surveillance. The same system that fights crime could, in the wrong hands, punish dissent. Convenience has a cost, and that cost might be anonymity. Let's look at some real-world examples. China's e-CNY has already surpassed 1.8 trillion yuan in transaction volume. It's integrated with WeChat Pay and Alipay, giving the state a foothold in the digital payment ecosystem. The Bahamas' sand dollar was launched in 2020 to serve remote islands where banking services were scarce. It's a success story for inclusion, but adoption remains slow due to limited smartphone access. India's digital rupee is being tested for wholesale and retail transactions. The Reserve Bank aims to integrate it with the existing UPI system, combining convenience with state backing. Europe plans to launch its digital euro by 2027, emphasizing privacy by design, but the debate over surveillance continues. Every country's version reflects its priorities. Efficiency for some. Control for others. Will cash disappear entirely? Probably not. At least not soon. Even the most digital societies keep cash as a safety valve. It's reliable during disasters, private for small transactions, and symbolic of trust in physical form. The future likely lies in a hybrid model. CBDCs for everyday efficiency, cryptocurrencies for innovation, and autonomy cash for resilience and privacy. As money evolves, the bigger question becomes philosophical. When money is digital, and code decides how it flows, do we still control our wealth, or does our wealth control us? The end of cash isn't the end of money. It's the beginning of a new era, one where finance, technology, and power merge into a single network. Central bank digital currencies may promise convenience and stability, but they also challenge our idea of freedom. As we move toward this future, one thing is certain: the world won't just spend differently. It will think differently about money itself. This is Finance Decoded. And this was your deep dive into the future of money. If you found this enlightening, subscribe, because the next episode will decode how AI and finance are merging to build the next financial revolution.